Hi everyone, we're now going to review problem 13-2B, which is your practice problem on page 495. So in this problem we have Balthus Corporation reports the following components of stockholders' equity December 31st, 2018. So what I encourage you to do is create T accounts for each of these, starting with beginning balances as indicated. So I'm just grabbing a sheet of paper myself. So I'm going to create a T account for common stock, and it will have a credit balance of $200,000. I will have a T account for paid-in capital in excess of par, and it will have a beginning credit balance of $1,400,000. And then retained earnings will have a beginning balance, and these are all on the credit side, remember? All equity accounts, paid-in capital, and retained earnings, they increase on the credit side. They completed the following transactions related to stockholders' equity during 2019. So the first step we're going to do is prepare a journal entry to record each of the transactions. So this is a great review of a lot of the concepts we already discussed. January 10th, oops, sorry about that, the company purchased 40,000 shares of its own stock at $12 cash per share. So remember, this immediately takes us to that last concept we talked about in chapter 13, Treasury Stock. So when the company goes into the market, purchases its own shares, it's purchasing its own common stock, we debit, we could create another T account, Treasury Stock, which is a contra equity. It increases on the debit side for the total, 480,000, and that represents 40,000 shares that cost us to buy back $12 a share. Now you need to keep something in mind. At the top, when it told us the common stock, it said there was 320,000 shares authorized. So that's the maximum they could sell. As of the beginning of 1/1 of 19, I'm sorry, the beginning of the year we're working on, I want to keep track of the outstanding shares. That's very important for calculating dividends. So as of 1/1 of 19, there were 200,000 outstanding shares. We just decreased the outstanding shares by purchasing back 40,000 of our own stock. So remember, Treasury Stock decreases outstanding shares of stock. So right now there are 160,000 shares of outstanding common stock. That's important because March 2nd, the Board of Directors declares a $1.50 per cash dividend payable on March 31st to the March 15th stockholders of record. Now there's only one type of stock here, common stock. But watch what happens. You're only going to calculate dividends on the 160,000 shares that are common stock that are currently outstanding. So 160,000 shares times $1.50 dividend. We debit retained earnings on the day the dividend is declared, credit common dividend payable. We credit a liability account because we're promising to pay cash for the full amount. Remember, the date of record on March 15th is a date that we collect names of the people who own the stock as of March 15th. It's the ownership cutoff date. The next significant date related to this dividend is the payment date on March 31st. So on that day, common dividends payable will be debited for the 240,000. Cash is credited for the 240,000. The next transaction. Now the company is going to begin selling some of that stock that they bought of themselves. So they're going to take 24,000 of the 40,000 shares they repurchased and sell them for $13 per share. we will record the cash as the cash amount received, $24,000 times $13, or $312,000. We will only credit the treasury stock account for the 24,000 shares times the original purchase amount of $12 a share. So there's the second. Since you put them in at $12, you have to take them out at $12. So we're going to decrease, oops, and by the way, okay, I'll do that in a second. We're going to decrease the treasury stock account by 288,000, or 24,000 shares. Since we received more cash, or we sold them for more than we originally bought them at, we're going to credit another paid in capital. So I'm going to add another account, paid in capital treasury stock will be credited for $24,000. So I'm going to decrease treasury stock on the credit side to show those stocks are being now sold back into the market. We no longer own 24,000 shares of our own stock, or this company doesn't own 24,000 of its own stock. And the amount we actually made on it is put into a paid in capital treasury stock account. Now, one thing I want to bring to your attention is on March 2nd, I forgot to debit the retained earnings account for that dividend. So if you didn't do that in your T account, you may want to do it now. The 25th, the company is selling the remaining 16,000 shares of treasury stock, but this time they're only selling them for $9.50 a share. So they're only going to receive cash of $9.50 times those 16,000 shares, or $152,000. They have to remove the treasury stock, credit that account for $12 a share. So 16,000 times $12 a share is $192,000. Take note now, the treasury stock account has a zero balance. We have resold all of the stock the company owned of itself back into the market. This time, they sold it at a loss. They sold it for less than they originally bought it at, by 40 grand. Remember what we said the rule is. When you sell treasury stock at a loss, you first look and say, do I have an account called paid in capital treasury stock? If I do, does it have a credit balance? Yes, it has a $24,000 credit balance. Well, I will debit that for either the loss or up to the point that account is zero. So that's why we debit paid in capital only for $24,000. That paid in capital treasury stock can't have a debit balance. If there's any loss that is not debited to paid in capital treasury stock, debit retained earnings for the remaining amount. So if we didn't have a paid in capital treasury stock account at all, we would have debited retained earnings for the full $40,000. So the only time we would have paid in capital treasury stock is if we sell stocks we own of ourselves back into the market for more than we originally bought it at, like we did on November 11th. So now all the treasury stock that we originally bought up on January 10th has been resold into the market. December 1st, the directors declared a $2.50 per share cash dividend payable on January 2nd to the December 10th stockholders of record. Now remember something. March 2nd, we said, ooh, when we're getting ready to look at that dividend, we're holding some treasury stock. Do we own any treasury stock on December 1st? No. So our outstanding shares of stock are 200,000. So 200,000 times $2.50 a share will debit retained earnings, and you want to do that in your T account for 500,000. So 500,000 more of the profits are going out, just not today. So we're going to credit common dividend payable. That happens on the date of declaration. Even though you're not paying it until the future, once you promise to pay cash, you must debit retained earnings and credit a liability account. The final transaction for this year is they closed the $1,072,000 credit balance from net income in the income summary account to retained earnings. Before, we used to debit income summary and credit capital, or the various capital accounts of the partners. In a corporation, we credit that account retained earnings for net income. We increase retained earnings for net income. So I'm going to do that in my T account. So now my common stock T account still has a $200,000 balance. Paid in capital in excess of par still has a $1.4 million balance. But let's see what my retained earnings balance is at the end of the year. $2,160,000 is where it started. We're going to add the net income for the year of $1,072,000 and start subtracting first that dividend of $240,000. The part of the treasury stock sale that resulted in a loss that we needed to debit on November 25th, and then subtract the dividend from December 1st, $500,000. So I'm getting $2,476,000, but I'm just going to double check that because I don't trust my calculator here. Okay, so that's 756,000. Okay, so 2160000 plus 1072000 minus 576,000. No, see? Oh, Lori. Bear with me a second, guys. 2160000 plus 1072000. I have a very small calculator here. Okay, and then I'm going to subtract 756,000. $2,476,000 is the balance of retained earnings. Now, what's the big deal about that? Well, they ask us in step 2 and 3 to first prepare a statement of retained earnings. Now, I didn't show you that in the lecture, but let's take a look at it now. A statement of retained earnings only focuses on how retained earnings, just retained earnings, changed during the year. Sometimes companies do these. So a statement of retained earnings is considered a formal financial statement. So we have Balthus Corporation, statement of retained earnings, and we're going to explain how retained earnings changed for the whole year, where it started, why it changed, and where it ended. So we want to put for the year ended December 31st, 2019. So retained earnings started, so the balance either 1/1/2019 or 12/31/2018, $2,160,000. We added net income for the year. Remember, we credited retained earnings, $1,072,000. We decreased it or debited it for a total of $740,000 for the total cash dividends during the year. So you could add those two separate transactions together. And then we debited retained earnings because of the loss on the treasury stock reissuances or resales. So retained earnings at the end of the year, December 31st, 2019, $2,476,000. So in this statement, that's all we're focusing on is retained earnings. But in part 3, they say prepare the stockholders' equity section of the company's balance sheet as of December 31st, 2019. Now this is nice. I'm going to enjoy showing you this. So remember, we're just focused on the equity section of the balance sheet. Now it'll say stockholders' equity on our balance sheet. The first, since we only have one stock, we're going to put common stock. First, put its par value. This company's par value is $1. How many shares are they authorized to sell? They tell us that up in the top in the green box. 320,000 shares are authorized. And at the end of the year, 200,000 shares are issued and outstanding. Paid in capital in excess of par value common stock, 1.4 million. So it's just the balances out of these accounts. So if we wanted to know the total paid in capital, we would add those two together, and that would tell us how much money we received the first time we sold those shares of stock, $1,600,000. Retained earnings, we already determined that balance on the statement of retained earnings. So we would transfer it down to the balance sheet, $2,476,000. Add those all together, total stockholders' equity, $4,076,000. Okay. So that is problem 13-2B. I'm looking, I think I want to do one more, but it's not going to be a problem. I think I'm going to go to our quick study exercises. You have the answer keys for these. They're in Blackboard, but let me go through one or two of them with you, because we don't do anything with these items in this problem. So I'm going to go, this is on page 486, to my quick studies here. Sorry, it's going so fast. And I am going to go to quick study 13-3. There we go. Okay. So you have the answer right in front of you there, but let's take a look. Prepare the journal entry to record Jevenna Company's issuance of 36,000 shares of its common stock. First, assume the shares have $2 par value and they sell for $18 cash per share. So how much did they sell them for total? $18 a share times 36,000 shares. 648,000 is the total amount of cash. But remember, we're only allowed to credit our paid in capital, that common stock account, for the par value of the stock. 36,000 shares times $2 par, or 72,000. Finally, the overflow or the excess that the company received above the par value is credited to the paid in capital account, paid in capital in excess of par value common stock, 576,000. In part B, it's the same situation, but now instead of saying it has a $2 par value, it has a $2 stated value. We treat stated value and par value the same way. It's just that when you put the excess or the overflow in paid in capital, it's in excess of stated value. These are both paid in capital accounts, but because it's using stated value instead of par value, we just substitute the word stated value. Okay, we looked at that. I'd like to go to QS 13-7. This is looking at common stock dividends. We saw cash dividends in our problem, but common stock dividends. Here we have Epic Inc. has 10,000 shares, $2 par value common stock outstanding. Epic declares a 5% stock dividend on July 1 when the stock's market value is $8 per share. The stock dividend is distributed on July 20th. Prepare the journal entries for the date of declaration and the distribution date. And that's what you see in front of you. Remember, this is when the company is sending out more shares of stock as a dividend instead of a cash. So when you're sending out stock, you need to determine the value assigned to that stock for purposes of recording this dividend. In a small stock dividend, less than or equal to 25%, we use market value to determine the value of the dividend. So The total outstanding shares are 10,000. They're going to send out an additional 5% or 500 shares. 500 times $8 market value will give us retained earnings debit for the value of that dividend of $4,000. Since we're not sending out the common stock that day, we don't credit the common stock account yet. We put the par value of the common stock we will send out, 1,500 shares times $2 par value, in common stock dividend distributable account, which is a paid-in capital account. So if we had an account like this with a balance at the end of the year, we would list it with common stock, paid-in capital in excess of par common stock on our balance sheet. The excess value above par value is credited to paid-in capital in excess of par value common stock. Now on July 20th, when we actually do send out the common stock to the shareholders, we'll debit the common stock dividend distributable account so that it becomes zero for the $1,000 par value of the stock we're sending out. Now we could credit common stock. 13-11 on page 487. Let's take a look at that. Here, the company is issuing preferred stock. For this problem, the company is, Thomas Company is issuing 5,000 shares, $100 par value, 7%. Remember, that's a dividend percentage. Cumulative preferred stock for $102 cash per share. So first they want us to record the issuance of the stock. Debit cash for the 5,000 shares issued times the $102 selling price per share, or $510,000. That's what the corporation is receiving. The most they can credit preferred stock, remember that's an account like common stock. It's a paid-in capital account. And we store in there the par value of the preferred stock we sold. 500 shares times $100 or $500,000. Any overflow we received above the par value is put in a paid-in capital in excess of par value preferred stock, just like we did for common stock. So they each have their own paid-in capital in excess of par value accounts. Credit that for $10,000. Now, what's nice about this quick study is that we could practice a dividend. Assume the same facts in part 1. If Thomas declares a cash year-end dividend, what is the amount of dividend paid to preferred shareholders? Assume no dividends in arrears. Now, what does that mean? Go back to the lecture. When preferred stock, and only preferred stock would have this, is cumulative, any dividends that are not declared and paid in prior years are kept track of, and those dividends are paid first to the preferred shareholders. Well, there are none of this. Could you let him out? There are no preferred dividends in arrears. He's scratching the door. It's okay. So since there aren't any, let's calculate just this year's dividend. $100 par value of the stock times 7%. So one share of stock gets $7 dividend. There's 5,000 shares, so the total preferred dividend, $35,000. So just some practice in calculating that dividend. So please make sure you practice these as much as possible and post any kind of questions you may have to the discussion board.